Every candle on your trading screen is not just price, it's human emotion. Behind every bullish rally is hope. Behind every crash is fear. The market isn't moved by numbers. It's moved by psychology. And today, we step into a battlefield where buyers and sellers fight an invisible war, a war that decides whether you win or you lose. Ladies and gentlemen, let's begin with the foundation of every market movement, the primal forces of fear and greed. These two emotions are not just casual influences. They are the very heartbeat of the financial markets. Every price fluctuation, every rally, every crash, at its core, it is a manifestation of human psychology expressed through numbers. When you look at a chart, you might think you are seeing pure data, but you are not. You are seeing the collective hopes and anxieties of millions of participants, condensed into a line that moves up and down. Greed is often the more seductive of the two. It whispers promises of wealth, freedom, and success. It tells traders, if you don't buy now, you will miss the opportunity of a lifetime. And once greed takes hold, rationality begins to fade. History is filled with examples of greed-driven manias. In the 17th century, the Dutch tulip mania became one of the earliest recorded bubbles. Ordinary citizens, farmers, even laborers, sold their homes and farms just to buy tulip bulbs, convinced they would rise forever. At its peak, a single tulip bulb sold for more than a house. Eventually, the bubble collapsed, leaving many ruined. Fast forward to the 1990s, and we see the dot-com bubble. Companies with no revenue, no clear business model, were valued at billions simply because they had a .com at the end of their name. Greed blinded investors to reality. And then, of course, the crash came, wiping out trillions in market value. In more recent years, we witnessed the rise of cryptocurrencies. Bitcoin, Ethereum, and countless altcoins surged to unimaginable heights. Stories spread of ordinary people becoming millionaires overnight. Social media magnified the frenzy. Greed created not just an opportunity, but an entire culture of chasing quick gains. Yet, as history always reminds us, the fall was just as dramatic as the rise. Greed, then, is not just about money. It is about the human desire to escape mediocrity, to achieve security, to gain recognition. In markets, it manifests in over-leveraging, chasing trades outside your plan, and ignoring risk management. On the opposite side of the battlefield is fear. Fear is just as powerful, but instead of luring us with dreams, it paralyzes us with nightmares. Fear of losing money, fear of being wrong, fear of missing out, the famous FOMO. Consider the financial crisis of 2008. As markets collapsed, fear spread like wildfire. Banks fell, stock prices plummeted, and investors rushed to liquidate assets at any cost. People sold their homes, their stocks, their retirement savings, not because they wanted to, but because fear convinced them the end was near. Ironically, those who resisted fear and bought during the panic went on to achieve enormous gains in the years that followed. Fear creates irrational behavior. Traders exit winning trades too early because they fear losing profits. They hesitate to enter setups that fit their strategy because they fear being wrong. They hold on to losing trades because they fear the pain of realizing a loss. Fear, unchecked, destroys discipline. But fear is not always bad. In fact, fear has evolutionary roots. It protects us from danger. In trading, a healthy level of fear keeps us cautious, reminds us to manage risk, and prevents reckless overconfidence. The problem is not fear itself, but fear without control. Now, imagine these two forces pulling the market like a rope in a game of tug-of-war. When greed dominates, prices surge. When fear dominates, prices collapse. Most traders are tossed back and forth in this endless battle, entering and exiting positions based not on logic, but on whichever emotion is stronger at the moment. Picture a trader named Sarah. She sees the market climbing rapidly. Her strategy tells her not to enter, but greed shouts louder. Everyone else is making money. Don't be left behind. She buys in at the top. For a while, she feels triumphant. But then the market reverses. Suddenly, fear takes over. If you don't sell now, you will lose everything. She panics, exits at a loss, and swears never to repeat the mistake. Yet the cycle continues, again and again. This story is not unique. It is the story of thousands, even millions of traders across the world. It is the story of how psychology moves markets. So how does one fight this war? How does a trader resist being pulled into this endless cycle of fear and greed? The first step is awareness. You must learn to recognize these emotions in yourself. Keep a journal, not just of your trades, but of your thoughts and feelings during each trade. Write down what you felt before entering, while holding, and after exiting. Over time, you'll see patterns, how greed lures you in, how fear pushes you out. Awareness is the beginning of mastery. The second step is risk management. Fear and greed gain power when the stakes feel too high. If you risk more than you can afford to lose, every tick of the market feels like life and death. But when your risk is defined and acceptable, emotions lose their grip. Risk small enough that you can think clearly. The third step is patience. Greed thrives on impatience. It wants immediate results, instant gratification. But trading is not about the next trade. It is about the next 1,000 trades. The patient trader sees beyond the noise of fear and greed, focusing instead on consistency and discipline. Finally, learn to see fear and greed not just in yourself, but in the market itself. Extreme greed often shows in euphoric rallies, parabolic moves, and overextended trends. Extreme fear shows in panic selling, high volatility, and capitulation. These extremes often mark turning points. Remember Buffett's wisdom. Be fearful when others are greedy, and greedy when others are fearful. It is in these moments, when the crowd is consumed by emotion, that the disciplined trader finds opportunity. Fear and greed are eternal. They are not enemies to be destroyed, but forces to be understood. They will always exist in the market and in you. Your task is not to eliminate them, but to rise above them. Because when you master fear and greed, you don't just survive the psychology war. You begin to win it. Ladies and gentlemen, if fear and greed are the raw emotions of trading, then her behavior is the stage upon which these emotions are acted out. It is an invisible force that drives millions of individuals to move in the same direction, often against their better judgment. And it is one of the greatest traps traders fall into, the illusion of control. We often believe we are rational beings. We tell ourselves that our decisions are based on analysis, on logic, on strategy. But in reality, human behavior is far less rational than we think. The truth is, we are profoundly influenced by what we see others doing. In the markets, this means that even when our system tells us to wait, we may still buy simply because prices are rising. We may still sell, not because our stop was hit, but because everyone else seems to be panicking. This is the illusion of control, believing we are making independent choices when in fact, we are following the herd. Psychologists have studied this tendency for decades. One famous experiment was conducted by Solomon Asch in the 1950s. Participants were asked to identify which of 3 lines matched the length of a reference line. The answer was obvious, but when actors in the room deliberately gave the wrong answer, most participants also gave the wrong answer, simply conformed to the group. This experiment revealed something profound. We are more afraid of standing out than of being wrong. Now think about the market. A trader sees a stock rising parabolically. His analysis says it's overbought, but the herd is buying. Deep down, he doesn't want to feel left behind. So he enters, ignoring his strategy. Later, when an inevitable crash comes, he realizes his mistake. But by then, the damage is done. History is full of examples where herd behavior created both spectacular gains and devastating losses. During the South Sea bubble of the 18th century, investors poured money into a company with little substance, simply because everyone else was doing it. At its peak, shares traded at 10 times their original price. When reality struck, the bubble collapsed, leaving financial ruin in its wake. In the housing market crash of 2008, herd mentality played a central role. People bought homes they couldn't afford, banks issued loans without caution, and investors packaged mortgages into securities, all because everyone else was doing it. When the bubble burst, the global financial system nearly collapsed. Even in modern markets, social media amplifies herd behavior. A single tweet, a trending hashtag, or a viral forum post can trigger massive buying or selling waves, often detached from fundamentals. We saw this with meme stocks like GameStop and AMC. The herd rushed in, fueled by community spirit and FOMO, driving prices to levels unimaginable. Some profited, but many were left holding the bag. Why do intelligent people, with access to information and tools, fall into this trap? 1. Safety in numbers. Following the herd gives the illusion of safety. If everyone is doing it, it must be right. 2. Fear of missing out. Watching others profit creates anxiety. We fear regret more than loss, so we jump in. 3. Social proof. Humans look to others for cues on how to behave, especially in uncertain situations. 4. Short-term comfort. Following the herd relieves the discomfort of standing alone, even if it leads to long-term loss. These psychological pressures are powerful. They override logic, discipline, and even experience. The irony is that the herd almost always loses. Why? Because by the time the herd moves, it is too late. The rally has already peaked. The crash has already begun. The market is structured to punish predictability. For every buyer, there must be a seller. For every winner, there must be a loser. The majority cannot win because the majority is the herd. This is why professional traders think differently. They are not afraid to stand alone. They understand that when the crowd is euphoric, danger is near. And when the crowd is terrified, opportunity is close. So how do you escape the illusion of control and avoid becoming a victim of herd behavior? 1. Develop independent thinking. Trust your system, not the crowd. Ask yourself, am I entering this trade because my strategy confirms it or because others are doing it? 2. Embrace discomfort. Be willing to act differently from the herd. It will feel uncomfortable, even lonely, but in trading, discomfort often points to opportunity. 3. Recognize herd signals. Watch for parabolic moves, news-driven frenzies, and extreme volume spikes. These are signs of herd behavior at work. 4. Practice patience. The herd thrives on urgency. Slow down. Wait for confirmation. The best opportunities often appear after the herd has already acted. One of the greatest skills in trading is the courage to stand alone when necessary. Think of Sir John Templeton, who famously bought stocks during the depths of the Great Depression when everyone else was selling. He later became one of the most successful investors in history. Or consider Warren Buffett, who resisted the dot-com bubble when others rushed in. He was criticized at the time for being out of touch. Yet when the bubble burst, his discipline proved right. These examples remind us, to succeed in markets, you cannot be just another member of the crowd. You must be willing to think independently, even when it feels uncomfortable. Herd behavior does not only affect traders, it shapes entire economies. It creates bubbles, crashes, and systemic risks. It amplifies volatility and drives cycles of boom and bust. But for the prepared trader, herd behavior is not just a risk, it is an opportunity. The herd's predictability creates inefficiencies, and inefficiencies are where profit lies. The market rewards those who see through the illusion, who understand that the crowd's actions are not wisdom but reflex. If you can observe the herd without becoming part of it, you hold an advantage that most traders will never achieve. The illusion of control is seductive. It tells you that you are acting independently, when in fact you are simply echoing the crowd. The herd offers comfort, but comfort is dangerous in trading. The truth is clear. The herd cannot win. And so if you want to win, you must step away from the crowd. You must have the courage to think differently, to act independently, and to trust your discipline over the noise of the masses. In the battlefield of markets, the herd will always be the first to fall. But the trader who escapes the illusion of control, who stands firm when others rush blindly, will find not just survival, but lasting success. Ladies and gentlemen, if fear and greed are the forces that drive the market and herd behavior is the stage where those forces collide, then the final battlefield lies not outside, but within you. This is the most important war of all, the war with yourself. Because no matter how advanced your strategies, how accurate your analysis, or how sophisticated your tools, if you cannot master your own mind, the market will defeat you. Many traders believe success is about predicting the market. They spend endless hours studying charts, testing indicators, following news. And while knowledge is important, Prediction is not mastery. The truth is, you cannot control the market. You cannot control when a stock rallies or crashes, when news hits, or when a black swan event shakes the entire system. But what you can control is your response. And that is where true mastery lies. This is where ancient philosophy meets modern trading. The Stoics, Marcus Aurelius, Seneca, Epictetus, taught a timeless principle. We cannot control external events. We can only control ourselves. The Stoic trader understands that every chart is a storm, but within the storm there is a place of calm. He accepts uncertainty. He embraces risk. He does not seek to eliminate fear or greed, but to discipline them. When prices rise, the Stoic trader does not get carried away by euphoria. When prices fall, he does not drown in despair. He sees both as natural cycles, neither permanent nor personal. The Stoic trader is defined not by his wins, but by his resilience. One of the biggest traps in trading is tying your identity to your results. A winning trade makes you feel like a genius. A losing trade makes you feel like a fool. But this attachment creates emotional turbulence. The Stoics teach us to separate identity from outcome. You are not your last trade. You are not defined by your P&L. A trade is simply an event, an outcome of probabilities. Wins and losses are both part of the game. As Marcus Aurelius wrote, you have power over your mind, not outside events. Realize this, and you'll find strength. In trading, discipline is often spoken of, but rarely practiced. The Stoic trader treats discipline as sacred. He sets his rules, his risk, his process, and follows them regardless of emotion. Where the undisciplined trader breaks rules when the market tempts him, the Stoic trader holds the line, not because he feels like it, but because he knows discipline is the only true edge. Seneca once wrote, "It is not the man who is too little, but the man who craves more, who is poor." In trading, this means greed will always whisper for larger positions, quicker profits, bigger risks. Discipline silences that whisper. Another principle of Stoicism is acceptance of fate, amor fati, the love of what happens. In markets, uncertainty is inevitable. You cannot know the outcome of any single trade. The Stoic trader accepts this. Instead of demanding certainty, he embraces probabilities. He does not chase the illusion of perfection, but focuses on executing well over the long term. Losses are not failures. They are tuition, the cost of participation in the market school. This mindset frees the trader from the paralysis of fear. When you accept uncertainty, you no longer resist it. You adapt to it. Picture a hurricane. Around it, winds rage and waves crash. But in the eye of the storm, there is stillness. That is the Stoic trader. When the herd panics, when greed drives irrational rallies, when chaos reigns, the Stoic trader remains centered. He does not react impulsively. He observes, he decides. He acts according to principle, not emotion. This is not easy. It requires training, mental, emotional, and even physical. Just as athletes train their bodies, traders must train their minds. Meditation, journaling, breathing exercises, reflection. These are not luxuries. They are weapons in the psychological war. So, how do you cultivate the Stoic mindset in trading? Here is a framework. 1. Define your rules before entering the battlefield. Decide your entry criteria, exit criteria, and risk per trade. Then commit to follow them. 2. Detach from results. Judge yourself not by wins or losses, but by whether you followed your process. A losing trade executed well is a victory. 3. Embrace volatility. Instead of fearing volatility, see it as opportunity. Calmness in volatility is what separates amateurs from professionals. 4. Train resilience. Journal every trade, not just technically but emotionally. Ask, what did I feel? Why? What can I learn? 5. Think long term. A single trade means nothing. 1,000 trades define you. Focus on consistency, not immediacy. The Stoic trader knows that markets are temporary, but character is permanent. He knows wealth may come and go, but mastery itself remains. This mindset transforms trading from a chase for profits into a path of personal growth. Every trade becomes a test, not of the market, but of yourself. Marcus Aurelius wrote, If you are distressed by anything external, the pain is not due to the thing itself, but to your estimate of it, and this you have the power to revoke at any moment. The Stoic trader lives this truth daily. Ladies and gentlemen, the ultimate psychology war is not fought between buyers and sellers. It is fought within you. Fear and greed may push you. The herd may tempt you, but only you can decide whether you will remain a slave to emotion or a master of discipline. The Stoic trader understands the market cannot be controlled, but the self can. And in mastering the self, he finds the only edge that never fades, never breaks, never betrays. Because in the end, the greatest trade you will ever make is trading your own weakness for strength. Now the question is, what kind of trader will you be? Will you remain trapped in the cycle of fear and greed, chasing the herd, reacting to every candle like a puppet? Or will you step into the battlefield with discipline, clarity, and stoic strength? The war between buyers and sellers will never end, but your victory lies in how you choose to fight it. So today, I challenge you, don't just watch the market, master yourself. Don't just trade for profit, trade for growth. If you're ready to rise above the noise, to step away from the herd, and to join the minority who truly understand psychology, then this is your moment. Take this knowledge, apply it, and let your next trade be the first step toward mastery. Because in the psychology wars of the market, the greatest edge is you,